For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and health care? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future. This is Managing Your Financial Future. Hi. Hello. Johnny Dean, your podcast host, here with Rick. I should call you Ricky. Ricky Plum. Does anybody call you Ricky?
Not since high school.
Yeah. You used to be a Ricky years ago.
And then my son was a Ricky. Now, if anybody, he's a Rick now, too.
Yeah, he's a Rick. I've been John my whole life, except when I started the radio show.
Johnny Dean.
I became Johnny. It just flowed. And I didn't do that, but somebody else did. And now here we are. Now, Rick Plum, okay, get this. You are a certified financial planner professional.
Yes.
And you are an accredited wealth management advisor.
Yes.
You know how I know that?
How's that? Because I keep telling you.
Well, I should thank listener. I'll just call him Joe. It's his name, of course. Listener Joe, somewhere in the Midwest of these fine United States, sent me a cheat sheet. He laminated it. Now, if you've been listening to the episodes over the last several weeks,
John screws
months,
up my designations from time to time.
Well, you've always been a CFP professional, right? I mean, forever.
Well, for the last 30.
But just recently, you became an accredited wealth management advisor. Not that long ago. What? Within the last 6-8 months?
Roughly, yeah, January.
Yeah. So you kept saying, well, we need to mention that on the air. And then
I worked hard for that.
I'd forget in the beginning. And then became a joke, gee, what are you, an associated chimney sweep? What? So anyway, part of that was one of our listeners made me a cheat sheet. And as I said, Joe, he actually laminated this thing.
Well, he put the name.
It says Rick Plum at the top. Yep. And
it's got the logo for each of the designations as well.
Doesn't it? So it says Rick Plum, and below that it says Certified Financial Planner Professional.
Yes.
Which is what you are. And then has the CFP Board of Standards logo that says Let's Make a Plan.
Uh-huh.
And then right below that it says Accredited Wealth Management Advisor. And below that, I didn't know they had a logo, Accredited Wealth Management logo, I guess. Anyway, so my thanks
so
to...
you can't mess it up or forget it anymore, thanks to our listener in the Midwest.
Yeah. So thank you. I do appreciate that. It's always good to know that people are paying attention, which is, I think, important. Well, as I said, it just became kind of a funny thing to do. And then I said, well, I think I've milked that enough. But now I've got it. Now I've got the cheat sheet. So I do remember you are a CFP professional.
Yes.
All right. So enough of that housekeeping and so forth. Don't forget, you can email us if you ever want to. You can email us at go to luciacap.com, luciacap.com. I should mention that at the top of the show because I don't. And every so often we should do emails. I think like once a year, Professor, we take some emails we've gotten and just answer them.
And if they're timely, we will do one if it comes in. But
sure.
If you have items you'd like for us to discuss, areas of financial planning that you are confused about, or you've heard different courses of action based on the same thing.
Competing advice,
yes,
maybe?
Yeah.
I think we can set you straight.
Yeah,
so.
we can discuss where the ideas came from and why one may be more appropriate than the other at times.
Uh-huh.
It may be that both are valid courses of action, but not for the same person.
Well, and that goes back to our standard answer, which is it depends.
What's the answer? It depends.
It always does. So today, speaking of timely, now I don't know when people listen to these things, and by the way, we record these well ahead of the date, but we're into, I believe, August now is when this particular podcast is going to be sent out. And we are at the time of year, Professor Plum, where people should be thinking about where they are this year and where they want to be.
Right. It's kind of a mid-year checkup.
It is. We're
a little
more
past mid-year,
but that's okay. See, part of the thing is we get people asking us stuff sometimes in December and saying, well, I seem to not be on track with taxes, or what can I do between now and the end of the year? And you say, well,
there's not a whole lot.
You got about 20 days left. So it's not a good time to be thinking about that. And at the same time, if you're early in the year, there's certain things you can do early in the year, but you haven't had enough time to determine where you are.
Well, it depends on how your income, your financial life is structured. Some people are very similar from year to year. Their income doesn't change. Their life, as far as their tax returns, they don't change. Yeah. It's very easy to predict and easy to understand what's happening. Other people, their incomes are very variable or volatile, or maybe they have assets that they're selling. And the larger your personal portfolio, the more you've recognized this, where some years you have big capital gains, some years you don't have any capital gains, and it makes a big difference on your tax return, how much you pay in quarterly payments and all this other stuff. And it also makes just planning a little more difficult. But as we progress through the year, we're getting a better idea of where we might sit this year. So it all comes down to, am I withholding enough tax? Should I be looking at Roth conversions? Am I doing my RMD on time? There's all these things that we can look at to decide, should I be taking more than my RMD, or think, am I putting enough in my 401k to either max out? There's all these things that we still have time to be able to make adjustments, to be able to actually have time through the rest of the year to affect change.
Well, let's talk about some of these things. I'm going to throw out a few different pieces of the puzzle, and you just tell me what people need to be thinking about. Now, you mentioned 401ks. Sometimes some people around this time of year wind up maxing out their FICA tax, right? In other words, their 6 point.
If you're making $320,000 or more, you're doing it halfway.
Is that what
through.
It is now?
Well, no, that's if they're maxing out halfway through the year, they'd be making $320.
Yeah, okay, but I mean,
the wage base is in the 168, 600 range.
But sometime between now and the end of the year, this could be happening.
Right. If you're making $200,000 or more at some point during the year, or 168, or call it 170,000 or more, at some point during the year, you're going to hit the maximum Social Security taxable wage base, meaning that they're no longer going to withhold Social Security taxes. Medicare is going to continue to be withheld, but the 6.2% that you pay in FICA is going to stop being withheld from your check because you're no longer paying into the Social Security system. So you get a little bit of a raise.
Well, if you haven't maxed out your 401k, would that be something to potentially add to your 401k? I'm just throwing things out. What should people do with their 401k?
Well, the 401k is you should be looking at it and saying, how much am I saving? Am I on track to do what I wanted to do? Or can I do something? First thing I would want to make sure is, am I on track to make sure I'm getting the full matching contribution? I want that money. That money is my money that is owed to me for working here, not putting enough into the 401k and not getting the match. That match is part of my salary. I mean, it's part of my wage, my compensation base. So I want to get all the compensation that I'm entitled to. One of the ways to do that is make sure that you're putting in enough in your 401k to get that matching contribution. Am I on track to get that full matching contribution? Once you're through there, am I on track to meet the goals that I want? Depending on how much you're saving and where you're at, maybe they're matching up to 6%. So that's my first goal. And then the next goal is, well, they say you should save at least 10%. Am I on track to do my 10%? And then how much close am I getting to? Am I on track to maximize? Put in my full $23,500 for this year, my full $30,500 if I'm 50 or older. Yep. Am I on track to put that in? A lot of times, I'll try to do this at the beginning of the year, but maybe the beginning of the year, some things I've looked at what's coming. I just can't afford to do it right away, but maybe things have loosened up a little bit and I can start saving a little more.
Well, and that's why I mentioned maybe
you're going to get that
base.
little raise.
Yeah, potentially.
And so, it's not a raise. It's a raise in my net deposit into my bank account.
Your net check will go up, and you're not going to be that tax goes away.
Am I on track to accomplish in my 401k what I need to accomplish? Getting the matching contribution, bumping it up. I've worked with a lot of the younger people that work in these areas. Have you included the automatic escalator on your 401k? A lot of the 401ks now have an automatic, bump it 1% every quarter, every 6 months, every year, or whatever the case may be. If I'm doing 6, make it 7, and it happens automatically. And most of the time you don't notice it, but that doesn't mean you can't also do it in addition to that.
Yeah,
saving is good.
So they say if you bump it up once a year, another 1%.
I'd like to see that every 6 months, but of course I'd like to see more money. But
well, yeah, you got to make sure you can afford.
You got to live.
That, so, all right. So you should look at your 401k and see if you've taken advantage of the match.
And for most people, you don't need to really, especially younger individuals under 50, maybe you don't need to check your allocation too carefully because it's all growth, or at least it should be all growth. So maybe you check it to make sure it still is
young,
all
as
growth.
in 20s, 30s,
No, I'm saying under
40s.
50. I mean, unless you want to retire at 50.
Well, no.
If you've got 15 years or more, it should probably be all growth.
20s, 30s, 40s, and 50 maybe.
So look at your allocation. See if there's anything you want to play with. But the biggest thing is the savings component and the match component. Get that done.
Yeah, and there may be nothing to change, but at least take a look at it.
Yeah, but make sure you're on track.
401ks are generally designed as a sort of set it and forget it thing, especially for younger people. But that doesn't mean that you shouldn't glance at it from time to time and make sure it's
and
doing
the
what
best
it
time
needs
to look at it is in December for the next year.
Yeah.
So if you're of the mind to max it out in starting pro rata over the whole year, what is the maximum you're going to put in? Divide by the number of paychecks you're going to get for the year, and figure out how much. Put that much in every paycheck to get to for the whole year.
That's a very good point. All right, so that's the 401k. Now, what about, say, your stock portfolio, your personal stock portfolio? Is there anything you need to be looking at for that? And I'm not talking about, obviously, retired people as part of their. You can do that as part of your bucket strategy review.
Well, how has the world treated you this year so far? Now you're starting to look at getting ready for towards the end of the year tax planning. You're through the year. Did you have any big gains early in the year that you may want to offset? And so you don't have to wait till the last second to do tax harvesting. It usually we do wait later, but now it's just a matter of, am I still where I want to be? Did I own X stock that just took off and is now 80% of my portfolio, which may be a little bit too much. This is a good time to start taking a look at, where am I at? Where am I supposed to be? Should I start thinking about, the risk that I'm facing with individual securities and paring back or adding to different areas? Well,
if you need to do that, now this is kind of the rebalancing is sometimes what they call it. A lot of people will look at it and say, boy, this stock has really done well. I sure hate to take any money out of that. But if you decide to do that, I mean,
I'm not saying get out of it altogether.
No. But you're saying maybe pare back. But what do you do with the money that you're paring back on? Do you put it in something else that's down? I mean, how do you determine what to do with that?
That's one of the hardest things about managing a stock portfolio. Not only is it what should I be selling, but what should I be buying? And so when you're evaluating a stock, whether you should sell it, is, do I have something that I think is going to do better than what I'm already in? And
who knows?
And it's hard. That's one of the hardest things. But at some point, if you're way overweighted in a specific security, there's a risk factor involved. And that while it could continue to do well, that one thing could hurt you. We talked, a couple weeks ago about it's easier to become wealthy than to stay wealthy.
Oh, 100%.
And one of the problems with staying wealthy is maybe staying with things that you really shouldn't stay with, and maybe you should forget just going into another stock. Maybe you should be, getting to a point where you're paring back, getting ready for getting some dry powder on the sidelines in case the market goes down. You can buy in. So by selling off some of the top and creating some future purchasing power.
And we're not talking about timing the market. This is not,
because I have no idea what the market's going to do tomorrow, next week, next year.
No.
We've got a lot of things that could affect it dramatically or not.
I would suggest, just based on what you're saying, Professor Plum, is that if you are going to mess with your stock portfolio a little bit and say, I'm more out of balance than I need to be, I would suggest somebody at least get a little bit of help with this.
Well, and this is something, why are we talking about now? Because most people haven't looked at their portfolio for at least 6-8 months since December of last year.
Sure.
And so why do we only do it once a year in December? We can be looking at it more often, and I think watching your portfolio helps you understand and helps actually build a discipline. Wow, I need to save some more.
That's true. That's true. But you also don't want to overdo it. There are people who are looking at this and fretting about it every
daily.
day. No, but keeping in mind what you just said, but we're also keeping in mind that these are really long-term plays anyway. You're not doing this.
They should be if you're in the stock market. Otherwise, you're doing wrong.
Exactly. So you're not doing this rebalancing to try to maximize your gain this year.
No, you're trying to manage the risk in the portfolio. I mean, maximizing gain is putting it all on red or all on one security.
Gambling, in other words.
Yeah. I mean, that's how you maximize.
Right.
It's also how you minimize. Potentially.
What's the best way to make a small fortune in
Start
the
with
stock
a large
market?
one.
Start with a large fortune. All right, so stock portfolio. As I said, I would suggest people maybe get some help with that because you can mess it up, and emotions can play a role in all that stuff.
Emotions. I have every once in a while somebody come in with a stock that is just dying on the vine, and they're like, "Yeah, I bought this as a flyer, and it's just a dog. It didn't work right." And I was like, "Well, let's sell it. I can't sell it. I got to wait for it to get back to what I paid for it. It probably will never get back to what you people get emotionally invested in their losses, and it's like, no.
I remember that.
If you got $1,000 left in it out of the 10 you put into it, if you had $1,000 a day, would you buy that stock? Oh gosh, no, it's got no chance. Then why are you keeping it there?
You had to talk me into that. Do you remember back in the tech boom? Remember about 1990? Or
I remember the tech bust with you.
2001 is actually. I had that mutual fund, which will go nameless, but I bought it at like $35 a share.
He bought it about 10 days before the crash.
It went up to 40 within 10 days, and then of course it crashed.
Yeah, it was down about 4.
And I think. Yeah, the low was 6.5.
Okay.
And finally, it took me 4 years, Professor Plum, to get rid of that thing. It had not changed. You finally said, you talked me out of it.
Yeah.
Sell it.
That's how long we've been working with each other.
It was like, yeah, exactly. This was
and we weren't brand new working together in 2001.
No, it was just stupid. All right, so stock portfolio. Okay, so what about Roth conversions? Let's talk about those for a minute. Is this a time to consider those?
Well, any time's the time, but for a lot of people that don't have a good handle on what their income is, now's a good time to start getting ready, seeing where have you had any unexpected events happen through the year? Where are we projecting to be for the end of the year? And start warming up to the idea of, okay, how much am I considering? I think that if I continue on the same line that I'm doing now, my income is going to be X amount of income. At that level, I have $20,000, $30,000, $40,000, X amount of dollars of room available to me in my current tax bracket. And that is better than waiting until I retire, because my income tax bracket may be worse than retirement, especially when you consider the taxability of Social Security at times. So I have some room. Maybe I should be doing some Roth conversions and start getting ready for it. And maybe in the aspect of getting ready for it, you're saying, well, I can't use the conversion to pay the tax. So maybe I increase my withholding now in anticipation of the fact that I know I'm going to do a conversion, or probably going to do a conversion at the end of the year if something doesn't happen that creates a huge gain, or I get a bonus windfall or something of that nature. Either way, I'm going to need tax money. Get ready for it so that I don't have to figure out, okay, I'm going to do a 40,000 conversion. I'm going to need $25,000 or $22,000 in, or not 22,000, $11,000 in taxes. Where's that tax money going to come from? Well, if I've been putting in a little bit away every paycheck, it's a lot easier than putting it away at one lump sum.
Now, you're not suggesting people should just willy-nilly do Roth conversions, because as you said before, Professor
No, you need
Plum,
to know why you're doing a Roth conversion.
Yeah, you need to know where you are on the tax, in your tax bracket, certainly. You don't want to create more taxes. What else do you need to look for when doing these Roth conversions?
Well, I had a class this morning, a training class, on what to look for on the tax return.
I saw that on the little chalkboard you had there. I walked right past that meeting.
Yeah, we were going over tax returns and evaluating what to look for, how to evaluate where we are, and what the true cost of additional money, which would be a conversion or something of that nature. What is it costing me to do this? You have to know what it's going to cost you, and then you can try to project what it's going to save you in the future, or conversely, not doing it today cost you in the future. And so the idea is, how do we know what it is? And just looking at the tax bracket is only one piece of it, especially for retirees where they have a large portion of their income covered by Social Security. Maybe they got $50,000, $60,000 of Social Security, and they're living pretty well. They take a little bit out of their IRAs. They're looking at the fact that, wow, maybe we're not paying any taxes, so we should be able to do quite a bit. But then they take 10 grand out and they say, well, I'm in the 10% tax bracket, and their taxes go up by 20% on that $10,000.
Guess why?
Well, that's still maybe a good deal compared to what it might cost in the future. But they were expecting a 10% bracket, and they got a 20 or 18% bracket. 19% bracket, and they're like, wait a minute, how did this work? If I would have known the true cost, and that's what I'm talking about, start getting yourself in line to figure out what it is that you're going to have available to you, what your income is going to look like. If your Social Security, how much is your Social Security? There's all these things we want. it's a lot easier to get used to it and get ready for it as we go, rather than all at the last second. Oh, it's December. I forgot about all. I got to get all this information together so I can figure out whether or not I need to do a conversion before the 31st. Because yes, conversions for this tax year have to be done during this tax year. Unlike a contribution, which can be made up until the due date of the tax return
of the following year.
When I have to file my actual tax return, the conversions count in the year the money leaves the IRA and goes.
When the ball comes down in Times Square and
conversions are done for that year.
You're done for that year. You have to actually do it in that year. Roth conversions. Now, a lot of people become enamored with Roths, and for good reason.
They're wonderful if you can do it efficiently.
But there is a cost of admission, and this is the thing that I think that some people get caught up in, and they don't really think about necessarily the true cost.
And you have to understand it, because depending upon what's happening, it may subject you, obviously, to your Social Security to taxation. It may bump you into a higher tax bracket. It may throw your capital gains, your dividends and interest into the net investment income tax area. It may throw your capital gains, which were 0% bracket before, into the 15% bracket now. And also tax some of your Social Security. And you're like, wait a minute. Like, I wasn't paying any tax on my capital gain before, and now I'm paying 15%, and I have to pay tax on my Social Security as well. What the heck is going on? Yeah. So know what the cost is, so that you know. And with retirees especially, because they're typically on regular, they have a fairly regular income, unless they have a big investment portfolio that can vary from capital gain from one year to the next. But every once in a while, they do things like they sell a piece of property.
That happens more than people know. I mean, they decide they're going to sell their home they've lived in for 50 years and
it's got more gain than $500,000,
and it's got way more gain than $500,000,
and that becomes a taxable event. And there's, but it's also, I think you call it recency, but may have sold something in January we forgot all about.
Yeah,
get your paperwork together, get yourself programmed, get yourself in line, so you don't have to do it all at the last minute.
All right, so Roth conversions, again, I would suggest you get somebody to help you with this.
Yeah, but
just understand what the ramifications are. What is the cost of admission on a Roth conversion? The other one here that people probably should have been thinking about early in the year, but can do it anytime. What about required minimum distributions, RMDs?
Well, RMDs from your own IRAs and RMDs from inherited accounts. We found out earlier in the year, I was surprised about this, that people who fall into the 10-year category, where the owner of the IRA died in 2020 or later, and they were already taking required minimum distributions from the IRA, the beneficiaries of those, this is a fairly tight class, they have a required minimum distribution each year in the first 9 years. It's a 10-year clock now, but they also have an RMD in years 1 through 9. However, the IRS is having troubles getting their finalized perfect regulations.
So there's no penalty for not doing it.
So they haven't waived the RMD. They've only waived the penalty,
which in essence
means you've
waived the RMD.
Right. But it's nice to know what we're facing. Yeah. Just the fact that they've waived the penalty doesn't mean that you shouldn't be taking some money out of that inherited IRA to be able to pay some taxes on it now, rather than looking at it as a 10-year ticking time bomb.
Well, it may be beneficial.
I may have inherited $100,000, but if I leave it alone for 10 years, it could be $200,000, and that may throw me into a whole different tax bracket, a whole new bunch of problems.
You could wind up losing more in taxes 10 years from now.
It may be better to take 10, 12, 13,000 a year out of it. Inherited IRAs can't be converted to Roth, but I can take it out and invest it personally for capital gains and other things. So inherited IRAs especially, look into what you're going to have. And also, if you've inherited it already this year, but the person died earlier this year, make sure that the RMD for the person who died, maybe they died in February
and they hadn't taken it.
And you're finally gotten all your paperwork out and you've got it rolled over your name. Make sure that they took their required minimum distribution. Because although the penalty is nowhere near as bad as it used to be,
still 25%, right?
Still sucks.
Well, it does.
I don't like paying the taxes I owe, let alone a penalty.
Now, if you do that, if it's their RMD, it's in their tax bracket.
No, not if they've rolled it over to your name and they didn't take it. Now it's yours.
Oh, but it's their RMD, but it's now
their.
That's true.
It's the dollar amount that they have to take out, but
I see what you're saying.
It's taxable to the person that receives the money in this case.
You generally like to take RMDs early in the year.
I do because, most people don't have to worry about it because they're using the money to live.
Sure.
But for people who the RMD is something extra, where they don't need the money. I like it early because then I can invest it for growth. Mm-hmm. And instead of having that growth happen inside the RMD, which makes next year's RMD, inside the IRA, which makes next year's RMD larger, I invest it for growth in my personal account, and it's not part of the IRA, so it doesn't affect my future RMDs negatively. And heaven forbid the asset goes down in value, I can sell it and take a loss against my tax return, at least up to $3,000. That thing's been around since the 70s. I think maybe before that even. I researched it once when it came into play, the $3,000 tax loss limitation.
I thought it was like 68.
And it might have been. I'm trying to remember now. It's been a few years.
It was around the time that the minimum tax, the alternative minimum tax, I thought.
That was later than 68.
Was it? Okay. Well, anyway, it doesn't matter. It's been in effect
but it's
forever.
Been around, and it hasn't changed in forever.
Hasn't changed. They haven't raised the Social Security
thresholds.
So, but of course, they have raised the amount.
Everything else.
Yeah. Well, no, they've raised, what are we, $26 million for
the estate tax.
The estate tax, of course, because all those rich people are making the laws. All right, but RMDs, you should be taking a look at this. Okay, the last thing here, this sort of all comes together with taxes. There's not much you can do. Actually, there are some things you can do between now and the end of the year to potentially mitigate some taxes. You talked about 401ks.
Well, I bring this up because a lot of times we have people who are habitual big-time payers in April and complaining that they owe taxes every April. Yeah. And they have to pay penalties for underwithholding every April. Like I said a few minutes ago, I don't like having to pay the taxes I owe, let alone having to pay a penalty as well. So we want to be on track to make sure that we're going to pay in through withholding or estimated payments the correct amount. But now that we can earn some money on the savings that we have, I don't want to give them too much money. I don't want to get a $50,000 refund. We were looking at a tax return this morning in our class, and a person from last year got a $30,000 tax refund. It's like, wow, that's a big tax refund. And if they would have had that money in savings through the year, rather in their personal name, rather than giving it to the government, they could have earned several $1,000s in interest for doing what? For spending 10 minutes to make sure that they didn't overpay on their withholding.
Right.
And so we want to make sure we pay in enough. So are we on track? Again, this is the time, because we have enough time left in the year to affect change. This is the time to see if we are on track for the things that we want to be on track for. Are we on track to do our forming? Are we on track to pay in enough to avoid penalty, so that we don't have to come up with, where am I going to get $10,000 in the taxes I owe in April? I'm going to have to go on a payment plan again. There are people that are perpetually doing that, and so now, how do we make sure that it works?
Under withholding penalties, they're more now. You have to withhold a certain amount,
right?
And there are, though, Professor Plum, what they call safe harbor rules on these particular things, because some people don't know how much they're going to make until the end of the year. They have a big,
self-employed.
Correct. Yeah.
But the idea is we have to pay in through quarterly withholding or quarterly estimated tax payments, or withholding from paychecks, IRA distributions, or other things. Social Security, you can withhold from your Social Security paychecks. There's a form for that. You have to pay in at least the lower of one or two items, at least 90% of this year's tax bill.
Whatever that is.
But you may not know what that tax bill is, especially if your income is very volatile. Or 100% of last year's tax bill. Yes, you know what last year's tax bill, not what you paid in April. Go to the line, and I think even if you're not doing estimated tax or anything like that, go to the line that says this is your total tax, and just see how much you paid in taxes last year, and you'll probably get ticked off.
But it's 100% unless you make over
unless last year you made more than $150,000, then you have to pay in.
Married couple or individual? Couple. Okay.
All right. And then you have to pay in 110% of last year's tax bill. So the lower 90% of this year, 100% of last year's, or 110%.
All right. So let's say you have a huge capital gain for this year. You got $1 million capital gain, let's say, because you sold a property.
Right.
And you say, geez, okay, well, I don't.
I'm going to owe $180,000 in taxes.
Right. But I could say, okay, I don't want to pay it now. I want to pay it in April. I
want to put it in the bank account or a T-bill earning 5% between now and then, or 5% annualized between now and then. But
so I can go back to last year's
Right.
the 20. Let's see, in this case, 2023 tax return that I just filed here in April.
What was my total tax?
And I see my total tax. My total tax. I paid $10,000. Okay, $10,000. So
long as you've paid in, and last year your income was $149,000.
Right. So all I have to do is pay $10,000
through estimated taxes or through withholding. As long as you pay 10, you can make up the difference in taxes when you file your return in April without having to pay a penalty.
So if you got a job that's fairly stable with your income, I mean, maybe you're already withhold.
Yeah, if you normally get a refund and this is a one-time event,
right? You may be able to keep the whole thing till April.
Yeah, most of it. Yeah, or all of it, and have it invested and earn some interest for yourself.
Right.
And you're not taking any risk with that.
Yeah.
You're not paying any extra. You're going to pay the taxes you owe anyway. The question is, do you want to pay it now or later? So it's just a matter. And on the other side, if the big tax bill, the sale was last year, and you had you owed $60,000 or $100,000 in taxes last year,
right.
but your income's back to normal this year, and your tax preparer set you up with quarterly payments of
based on
$30,000 a quarter because of last year's tax liability. It's like, wait a minute.
Here comes that big refund you were talking about.
I don't want to do that. I just want to do at least 90% of this year's projected tax bill so that I don't have to get a huge refund and I can have that money working for me rather than working for the government.
Well, and that's something to look at. So these are the things that you should be looking at about this time of year.
Now's the time where you need to check. It's just that, am I on track?
Yeah.
Because I have, like I said many times in this broadcast, I have time to make a change and have it have an impact on the overall. If I wait until December to do all this, I don't have time.
Now, not only do you have time now, but you've got enough information, probably just enough information after 8 months or whatever, to make a determination as to where you're headed.
And if you're going to sell another property between now and the end of the year.
Well, I would hope so. Although these days, who knows?
They sell pretty quick.
If you want to know more about any of this stuff, you can go to luciacap.com, LUCIACAP.com. Don't forget to download our Bucket Strategy Guide. Go to the search bar, Bucket Strategy, type that in. You can download our free guide. Learn about the bucket strategy. It's also an estate planning guide. Type in estate planning, and you should be able to see that right first thing there. First choice to download that and any other guides that we have. We've got a Social Security guide. We've got all kinds of things. Just find it all there at luciacap.com, LUCIACAP.com. Is your portfolio on track? Are you on track? Do you need to meet with an advisor and talk with somebody about, hey, is there anything else I could do for this year? Have I done everything I can do? Find out. Give the folks at Lucia Capital Group a call. If you have not yet done so, 800-644-1150, 800-644-1150, and ask them. Say, hey, I'd like a review. I'd like to check. And if you're not bucketized, hey, probably time.
Get bucketized.
Get bucketized. We didn't really talk about that this time, but that's okay. Get bucketized and find out why you should. 800, thank you, 800-644-1150. I get choked up just talking about it. I think I need another sip of my Coke Zero here. Subscribe, podcast, Spotify, Apple Podcasts. Do it. I'd be glad you did. That's a direct command, by the way. My thanks to Professor Rick Plum.
He's reading off his cheat sheet again.
You are a certified financial planner professional, which I've got memorized. You're also an accredited wealth management advisor, yes. AWMA.
Yes.
And did we tell everybody why you're an AWMA?
Because I'm petty.
Because you're competitive. No, you're competitive. Somebody else in the firm
received the designation or studied for it. Got the designation. I didn't want them to be the only one with it.
See, there you go. So now they're not. Now you can say neener, neener, neener. It's a triple neener is what this is. All right. Anyway, thanks again to Joe for sending this. I think that's awesome. Once again, email us at luciacap.com. Professor, thank you.
You're welcome.
As always. And we will talk to you again for Professor Rick Plum. Johnny Dean, your podcast host, managing your financial future. Talk to you again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. We cannot assure the accuracy or completeness of these materials. The information in these materials may change at any time time and without notice. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you're required to take a required minimum distribution in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. 401k plan information used is obtained from sources believed to be reliable as of the current date, but no representation is made as to its accuracy and completeness. Benefits may be subject to change at your employer's, the governing pensions, or benefit organization's discretion. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Before investing, carefully consider a mutual fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.